This is a weak economy that's getting weaker. Consumers are on life support. They've depleted their savings. They've run up their credit card debt. Their wages are not growing nearly as fast as inflation. And all of this means stagflation. In fact, it's not just stagflation, because what we're going to experience is much worse than stagflation. It's not stagnation, it's depression. And the inflation is going to be much higher than what we got during the 1970s. As I've been saying, it's an inflationary depression. This is a very negative environment for the dollar. It's a very positive environment for gold. And it's only a matter of time until the rest of the world wakes up to this grim reality. Prices are going up, and the government responds by printing more money and sending it to people so they have more money to pay those higher prices, which means the prices go even higher. People are supposed to cut back when prices go up. But if the government gives everybody more money to pay the higher prices, then you're just fueling the inflation, and it's like a dog chasing its tail. You're never going to catch it, which is why the government's never going to bring inflation down. And that's why gold needs to be going up. That's why the dollar needs to be going down. 30-year Treasury bond yields are still a hair below 4%. Now, that's the only maturity that's still below 4%. But when inflation is over 8%, the only reason that 30-year government bonds yield under 4% is because the markets still expect the Fed to win its fight against inflation. Once the markets realize the Fed is going to concede and inflation is going to win, then bonds are going to fall through the floor and gold's going to go through the roof. And of course, the dollar is also going to tank along with bonds. And if the Federal Reserve tries to stop bond prices from collapsing by printing even more dollars, that will only make the dollar weaker and gold stronger. But again, it's not just Social Security outlays that are going up. What about interest payments on the national debt? The government is having to pay 4% now to borrow money instead of 1/4%. You're talking about a 16-fold increase in the cost of refinancing debt as it matures that has to roll over. And again, what are people who own these bonds, what are they going to do with that extra income that they're getting on their bonds? Well, they're going to spend that too, right? More money going into the economy, bidding up prices. But also, what about the enormous losses now that the Federal Reserve is suffering on its portfolio of bonds? Because some of these bonds, particularly some of these mortgage-backed securities, if the Federal Reserve is unloading those, they're doing it at a loss. Plus, the short-term interest rates that the Federal Reserve is paying to banks are now much higher than what it's earning on its portfolio of longer-term, low-yielding U.S. Treasuries. So the Federal Reserve is now operating at a loss. It used to be operating at a profit. And what did it do with that profit? Well, it remitted it to the United States Treasury. And so that was added revenue for the Treasury, which helped to reduce the budget deficits. But now, instead of sending the Treasury a check, the Federal Reserve is sending the Treasury a bill. The Treasury has to reimburse the Federal Reserve for these losses. And that means even bigger deficits, and that means even more inflation. And in fact, not only is Social Security having to spend more money because of these COLAs going up, but the labor force participation rate has fallen so much that there aren't nearly enough people paying into Social Security. Remember, in order for the government to collect Social Security revenue, people have to be in the labor force and working. The government needs young people working and paying into the system so we can keep this Ponzi scheme going. The problem is those young people aren't there working. And in fact, older people are retiring earlier. And so we have this smaller labor force participation rate. And so the gap between what the government collects in Social Security taxes and what it's spending in benefits is rising, especially now with this new increase, this 8.7% increase, because wages aren't going up anywhere near 8.7%. That means the collections of Social Security taxes are not rising nearly as much as what the government is paying out in benefits. So all of this is adding to the inflationary spiral. In fact, look what's going on in the UK. A lot of people are worried about fiscal profligacy in the UK because the government recently announced tax cuts in the face of rising inflation. You had a central bank that said, hey, we're going to fight inflation. We're raising interest rates. That's a contractionary monetary policy, but then you had a newly elected government saying, hey, we're going to have expansionary fiscal policy. We're going to cut taxes. We're going to increase budget deficits, even as we're pretending we want to fight inflation. Well, the markets were smart enough to realize that that was inflationary, and the British pound tanked. It hit an all-time record low. And in fact, finally today, officially, the British government has done a complete U-turn. They pivoted on the tax cuts. And in fact, the newly elected prime minister fired her newly appointed finance minister. I think he was on the job for less than 6 weeks, as if this was his decision. Like he made this decision in a vacuum. He decided on his own, let's cut taxes. And now the markets gave that the thumbs down. And so Liz Truss was like, oh, I better fire that crazy finance minister who came up with this idea about tax cuts. Obviously, she is the one that wanted the tax cuts. The finance minister was just doing what his boss wanted. But of course, they needed somebody's head to roll. So he became the fall guy. And now they got a new finance minister. But now they're not going to cut taxes, or at least that's what they're claiming. But why were the markets concerned? Well, because they were concerned about debts going up in Great Britain. Well, what is the British debt to GDP? It's 85%. Now, that is a big number. I mean, it is a number that should cause concern. I think anything really above 50% of GDP is too big a number. So because these tax cuts threaten to send British debt to GDP even higher, investors rightly dumped the pound. But what did they do? They bought dollars. They sold pounds for dollars, but they were selling pounds because Britain has got a debt problem. The irony is they were buying dollars despite the fact that the United States has an even bigger debt problem. Our debt to GDP in the United States is 125%. That's much larger than the 85% in the UK, but it's actually higher than 125% because that's just the federal debt. If you add the local, which is municipal debt and state debt, to that, now you're at 140% of GDP. We're in a much bigger fiscal mess than Great Britain. So selling pounds and buying dollars because you're worried that Britain has too much debt is jumping from the frying pan into the fire. But why are people doing that? Because America's debt doesn't matter, because America has the reserve currency. America is the currency that you buy when you're worried about something. It doesn't matter if we have a bigger problem than the problem that you're worried about, you still buy it. In fact, the most ironic thing is, I remember when S&P downgraded U.S. Treasuries. It was the first time that had happened. They downgraded U.S. Treasuries. And people were so worried about the downgrade of U.S. Treasuries that there was a flight to quality into U.S. Treasuries. So people bought U.S. Treasuries as a safe haven from U.S. Treasuries. That shows you how ridiculous it is. Well, it's ridiculous for anybody worried about a country having too much debt to sell that country's currency and then buy the U.S. dollar, which has even more debt. And the reason that you got to count the state debt and the local debt, and of course, even if you don't count that, we're still way above Great Britain, but you got to count that debt because the state governments and the local governments are drawing off of the same tax base as the federal government. The reason that debt to GDP is important is because you have to look at the size of the claim that a government has on its tax base. Well, in the UK, pretty much all the debt is on a national level. They don't have the states like we do, and they don't have all the municipalities. So we have so many levels of debt, but all of these governments are trying to get blood from the same turnips because Americans are broke. We have no savings. So can we possibly repay this debt? Of course not. Repaying the debt is impossible. So what's going to happen? We're going to default. There's only two possible ways we can default: the honest way and the dishonest way. But either is a disaster if you own U.S. Treasuries. The honest way is just to admit that we can't pay and we default. We restructure the debt and we tell our creditors you're not going to get your money. But I don't think politicians have the integrity to do that. They're going to take the coward's way out. They're going to print. They're going to inflate the debt away. That's the only way out of this problem, is to monetize that debt and repudiate it through inflation, which is why it's crazy for anybody to believe that the Fed is going to succeed in reducing inflation back down to 2%. it can't succeed. In fact, the only hope it has of getting out of this debt is to inflate it away. And they're not going to inflate it away 2% a year. They're going to have a much higher rate of inflation to have any hope of bringing this debt down to a manageable level in real terms, especially when interest rates go up. Because the only reason we've been able to afford the debt now is because interest rates were so low.